So up here we've got the lawyer group, okay, and as kind of a warning, you know, everything that you've seen in previous conferences will happen now yet again, a bunch of downers about what has gone wrong. But with all that comes some hope, because we actually have an interesting group. With that being said, I'm not going to introduce them because, let's face it, they're really good at talking. So with that being said, I'm going to turn to Dave, let him introduce himself, and we'll kind of go down the line.
So my name is David Silver. I am founder of Silver Miller. I am an early adopter of cryptocurrency litigation. I basically sue people who do ICOs wrongly. So I get invited to these conferences to say, please be my friend. Please don't do things wrongly. I want to be your friend. I want to help you guys succeed, because there are actors out there who haven't. Currently, I have the largest class actions in the country against Coinbase, Kraken, Bitfinex, BitConnect. What else do I have? Monkey Capital, Gigawatt. I basically have sued everyone in the space. Tezos right now they're fighting for lead class action plaintiff status. I expect to be named the lead plaintiff's counsel in that very shortly. But all of a sudden, Tezos is a perfect example. I used to be the only lawyer in the space who was doing plaintiff's advocacy work. Now every major law firm in the country has joined. I was a little player. I have a little niche. Now suddenly everybody wants in my space, and some of the big dogs came into Tezos, so now I'm partnering up with Robbins Geller, one of the largest firms. Basically, my attitude is very simple. There are rules, follow the rules, and everybody wins.
So you'll have all those buttoned up in the next 40. Go ahead.
Jason Nagi, I'm a lawyer. I work with Pulcinelli. We're about 800 attorneys not worldwide, nationwide. We counsel companies from early startup stage to mature companies. And if I were to name some of my clients, most of you, if not all of you, would have heard their name. We do counsel people in ICOs, and if you want to make sure that guy doesn't knock on your door, you want to come to an attorney that's in the space that knows it. And that's what we're here for. And yes, there are regulations, and we do want you to follow it, and we're going to make sure that you do follow it. So with that, I'll lead off to Gary.
Great. My name is Gary Ross. I'm a founding partner at Ross & Shoga, a securities law boutique in the financial district. We've been in the blockchain and cryptocurrency space since 2014. It's kind of interesting how it's changed since then. At first, it was all these Rand Paul libertarians and tech engineers, and it really changed last year once kind of big money got into it. And so I'm actually pro-regulation, because it wouldn't be a bad thing to kind of go back to that, where the focus wasn't always on raising capital and everybody getting rich. My firm, we're on both the company side and the investor side. So we've done a number of ICOs, and then particularly lately, our focus has been on forming funds.
Yeah, and I'm Mark Roderick, and you were forced to listen to me for 10 minutes earlier, so I won't. Well, I guess I'll say, yeah, I do a lot of crowdfunding work, ICO work. I write a lot. I speak a lot. And it's just very interesting to those of us in the space who were alive, let's say, during the 1990s, both from a regulatory and a market speculation perspective, to see the similarities between that market and this market. And I do want to congratulate our class action lawyer on the panel, because I think that really did turn out to be the niche, the real money-making niche from a legal perspective in the ICO world. And when I saw that, I said, darn, I wish I had thought of that. So just,
well, thank you. I, as someone who has been here from 2014, I graduated college in the early 90s, so I missed that first tech boom, but it's definitely been an interesting boom to watch. And I think we are in the process of the boom right now, regardless of what people think is happening in the price of crypto. If you go back a year, it's still a pretty good investment, and people have to have the long-term view on that.
I can just interject. I just want to interject real quick that it's good to me when David sues ICOs that have used large firms, because as a small firm person, I can say, hey, you can't trust these large firms. You need a firm like mine.
You are really, really going to
Keep
like
it up.
my advertising next week, because starting next week, it's all going to be, if you used a large firm for an ICO for the last 2 years, you might want to rethink how much you paid them.
So that's
You're gonna
good. So
like-
we'll turn to
go.
Jason,
Okay.
because this is like rebuttal time. But here's the topic, okay, Jason? Just because you're the biggest firm on the panel, right? We have a couple other real big firm people.
Let's pick on Jason.
And this will be for everybody. But Jason, I first want you to kind of identify from kind of a lawyer's perspective, like what is it as people are coming in and you're consulting that is the first thing out of your mouth where you're like, hey, you really got to know something. Finish that sentence.
SAFs are garbage.
Okay.
All right.
First of all, that, by the way, is both true and deserves an explanation. So if you could explain what a SAFT is, and then if you could talk through a little bit about what we are all seeing in the marketplace and in that.
Sure. So a SAFT is a simple agreement for future token. It was created or derived from another agreement called a SAFE, which is a simple agreement for future equity. If you go onto the SEC's website and you look at what they've stated in May of 2017, in bold and italics, the SEC said that a SAFE is often neither simple nor safe. So when you take a SAFE and you mix it up with a token, which the SEC doesn't really like also, you're creating what I've heard some people call the Frankenstein product, that the regulator that will be knocking on your door is not going to be happy with. Now, to the people that invented the SAFT, I give them credit because they tried to do something. They saw a space and they tried to do it. It's not bashing them. It just doesn't really fit right. If you're going to be doing a SAFT, what you really be doing is looking at raising money under Regulation D, which is to accredited investors. That's going to do essentially what the SAFT does. And there's a whole bunch of other options to go into this space, and there's a lot of discussions about what a SAFT is, but just because everyone's doing it doesn't mean it's a good idea. As a matter of fact, oftentimes it makes it not a good idea. So don't just jump in and do it. Think about it. Talk to someone that is a regulatory attorney in the space, someone that understands regulation. You probably want to hook up with a broker-dealer if you're going to be trying to give free stock to people for doing things. It's a complicated area, so understand when you think of SAFT, don't think simple. Think, I need to talk to someone who understands the regulatory issues so that my great idea and my investors' money doesn't get reduced for over-enthusiastic use.
So,
Well,
turning to you, with the appreciation that the first thing that you bashed was like this big firm idea of the SAFE that turned into the SAFT. What is it from your perspective, David, that you look at, right? And you immediately go, yeah, they did that.
So let's start with this. For the lawyer not to be named who left his position at Cooley yesterday or Monday, he was a big proponent of the SAFT for a reason. Cooley told all of their clients that there was something called the utility token that was pre-network. I am here to tell you, I've said this on camera many times, there's no such thing as a utility token pre-network. I will sue you if you sell one. And it's very simple. The chairman of the SEC said it yesterday. There's no such thing. Every ICO he's seen has been a security.
Let me just interrupt for 1 second. Is there a lawyer on this panel who disagrees with that?
With
With what David just said?
Well, no, but I think the way he said it, he left out some things. 'Cause
Okay, I do want to get back to that. So the reason I bring that up is because it has really been clear over the last year that there is basically no one who disagrees with that statement, with the caveat that Mark and I would say it differently.
And to be clear, I've been doing these panels once every couple of weeks for the last couple of years. I used to make that statement. I used to get booed off of every single panel from 2015 to mid-2017.
You can still boo him now if you want.
You can.
Yeah. Maybe that's one of the reasons.
And there's a reason for that, because The reason why people were booing me off the stage was because people wanted to sell their utility tokens and not comply with the laws. There's a reason, and I get to say I love that the SEC is here. I have so many whistleblower complaints filed right now. There's a reason that everything has changed and why the big firms right now are changing. And I agree, I am not a fan of the SAFT. I don't think it solves the problem. But I believe that it was a certain group of lawyers who went from charging $75 an hour in 2014 to over $1,200 an hour in 2017, who were giving bad legal advice. I've put this in writing, I've written articles about this. They gave bad legal advice, they gave bad investment advice, and they were staring down the eyes of the law. The SEC, the CFTC, for those of you who watched the testimony yesterday, they've made very clear that they're going after the lawyers in this. And it's going to be the first time we see something like that. And I think it's important because there was a lot of bad advice given in this space. The fact that you guys are in the room now, what I call ICO 2.0, it's very easy to be compliant. And if those who follow the rules hire a solid firm like Poznelli, whether they're defending some of my lawsuits, God bless them. I am a big fan of having my friends on the other side of the V. But ICO 2.0, doing it legitimately, it's easy, it's expensive, but it's easy, and complying with the law should be something everybody supports.
So to Gary, and then we come back. Agree or disagree with the "it's easy"? he kind of punctuated with "just follow the law, it's easy." Do you believe it's easy, and what does that mean to you?
Yeah, I've got a couple of things to add. So the one thing from a practitioner standpoint, the one good thing about the SAF, they came out and said it was a security. So even though people argue with me all the time over whether their token is a utility token or a security token, which is part of the reason those of us who have been in the space for a while only do security tokens now. Security tokens are funds and won't even touch someone who says that they have a utility token. But at least with the SAF, they came out and said it was a security. So it was a lot easier when you were dealing with clients. They weren't pushing back because it was universally accepted. Also, David's comment about whether the platform was working or not for the tokens, SEC made clear, so I agree with David's comment, but the SEC made clear in Munchie that it's not a determinative factor whether you have a working platform or not. So you could have a working platform, website, whatever, so there could be some use for the tokens, but that doesn't automatically make it not a security token. A lot of times people are adding some utility factor to something that's clearly like a speculative instrument, and that's not going to get you outside of the realm of the securities laws.
Well, with that being said, I will turn to you, Mark, because obviously we've kind of watched the regulations in various spaces in fintech the last few years. So kind of what's next from your perspective? What do you expect?
Well, so first I will say that the things, people have been saying for a couple decades that the pace of change in our lives as human beings, the pace of change keeps getting greater and greater and greater. And people note that like human beings are not even evolved to be able to experience all the change. Change used to happen slowly, now it happens fast. And the cryptocurrency market and the regulation thereof are a case in point. So like the .com market was, 8 years, 1992, say to 2000. The cryptocurrency market, we haven't even really lived through 12 months. And, you've already gone through the stages from euphoria to grief, so quickly. So everything's always out of balance from a regulatory perspective in this market because it just can't keep up. Last July, everyone, big firms included, thought tokens, we found the loophole to securities laws. We'll just call them tokens. So that was wrong. That balloon began to be punctured in August. We have now, dare I say on this panel, we have almost gone too far to the other extreme. Many lawyers will believe that even an active utility token is a security and must be treated as such under the securities laws. That is not necessarily true. So I do want to point out that we've gone too far. This market is just like the price of Bitcoin. the market is zigging and zagging in these extremes, and the perception of what's legal and what's not legal is also zigging and zagging to extremes, most of which are not warranted. So, with that said, I feel the same way about SAFs. So, from my remarks earlier, you know that I believe that usually you're better off buying stock than tokens. However, if you find a use case where a token in a particular company is better, there's nothing wrong with a SAF per se. It's not illegal, and I don't care what the SEC says about it. The SEC says a lot of things, just like the IRS does. They take very conservative positions. So I'm not going to say that SAFs are always wrong or are inherently evil. And if you're the issuer, if there's anyone out here that's trying to raise money for your business, what do you want to sell? You want to sell a freaking SAF because that's what people want to buy, right? The idea of raising money is to raise money. And I had a client tell me yesterday, thinking about a Series A round, my investors are telling me we want to buy a token instead. We want you to call it a token. So we're going to sell SAFs to those folks. We're going to do it properly. We're going to stay away from David. We're going to do it properly. It's going to be legal. It's going to be disclosed. We're going to treat it as a security. But if you're an issuer and you want to raise money and the market wants to buy SAFs, you sell SAFs.
Well, yeah, let me law school that question, okay? Why is it that they would rather sell tokens, and more importantly, why is it that the market would rather buy them?
Because the market's crazy. The market is crazy.
I don't disagree with that, but that is
Yeah.
a terrible answer.
No, it's not.
Well, I would
No,
say,
it's not.
I would say a lawyer saying that the SEC doesn't matter may go into that, but where I do agree with you is amazingly, the law hasn't changed in the last 2 years. And I think what Mark was saying is dead on accurate about the yin and the yang and the yo-yo going back and forth right now. The fact that, and you know, Chairman Clayton said yesterday, well, there are law firms who are actively protecting investors. Well, he was speaking about me because I did it for the first 3 years with nobody else. I have all the large ones now, including BitConnect last week for $2.4 billion that was stolen. There are other people coming into the space, but the rules haven't changed. The only thing that's changed in the last 2 years is the lawyers' perceptions of what is legal and how much trouble the lawyers are going to get in. So when the clients come, there are so many, and maybe easy was the wrong word. It's the reason why you need a quality lawyer to get you through the hurdles, but being compliant and doing it right, those who do it right are going to thrive in this environment because the investors desperately want to give their money to companies with good ideas. Now, we can talk about whether the process has been inverted, that companies are raising money before they actually have a product. That's a different story. Right now, quality lawyers can provide quality advice and let you do things legally, compliance-wise, and know your customer and everything else. If you want to take US dollars and you want to take US investors, hire a good lawyer and just do it right.
And it is easy. No one on this panel, I think, would disagree that doing an offering, let's say Rule 506C offering to accredited investors for a SAFT, that's an easy offering. It's easy to do it right. It's easy to comply with the SEC rules. It's easy to give all the required disclosures. It's easy to protect your client from future lawsuits to the extent that clients can be protected from future lawsuits if they're raising money from third parties. It's not rocket science. I mean, that's one of my big things. In the cryptocurrency field, there has been this sense of this is something brand new, this is going to revolutionize ethics and society, just like every other technology was supposed to do that. But it's not. It's not that new. And everything we do in cryptocurrencies to protect our clients, all four of us, except David, no, everything we all do is exactly what we do for every other kind of security that we're selling. It's easy.
So I'll push back on the it's easy thing a little bit. The whole idea of the secondary market and everybody wanting to sell it on an exchange is what makes it a little bit more difficult. So when you're talking to clients and you're convincing them that this utility token, this idea of trying to have a utility token is just asking for trouble, and it's okay. So you've convinced them to offer a security token, but then you're stuck with all these restrictions on secondary sales. And there's no easy way around that. There's Reg 141, there's holding periods applying, and so if you have a security token, then you're kind of stuck, and everybody is like, oh, there's all these exchanges, there's people getting rich off, selling these tokens. It's the entire reason a lot of people want a token to begin with, because they feel like it's more liquid. And then when you tell them that they're subject to all these Rule 144 restrictions, that's kind of where the difficulty lies. And I think that that's one area that it would help to have some guidance for the SEC. I mean, right now they're just saying that there aren't really this utility token thing, which I guess helps a little bit when you're trying to convince a client that that there's no such thing as utility token. But the whole idea of the secondary market trading, if there could be a little bit more clarity around that, that would help from a practitioner standpoint.
And, just to highlight, January was a very big month. If you looked at all that was issued, I mean, in January 18th, there were, I think, 3 CFTC complaints brought for fraud in the ICO market. It's getting frothy, and that's why there's a lot of attention. And one of the things that, people should think about when they're investing in an ICO is, if it goes bad, what rights do I have? And this is to something that Mark was saying in his prior 10-minute talk. Normally, you're buying a security. If you buy a token and your company goes bankrupt, you should also be thinking about, what do you have? And as someone who's done a lot of bankruptcy work, I think you have nothing. So it's really something to be careful about. ICOs are great, they're hot. It's almost better, I think, when they're treated as a security, but it just underlies the complex laws and interplays that are going on. It's right. What everyone said here is right. I agree with everyone, even David, right? He's the exception today. But it's complicated. You want to do it right, and you just need to consider all the angles. You can't just jump into it because it's a popular thing.
So I want to give one real-world example. Please. So let's use Tezos as a real-world example, because it was the largest raise at the time, and when problems arose, and ironically it was supposed to be all about governance, and the governance issue is now all they're fighting about. Yeah. But the real-world example is people who gave their cryptocurrency, whether it was Bitcoin, Ethereum, whatever they gave, they believed they were investing. Lawyers then determined, well, it's actually a donation, and then the Brightmans went around the country saying, well, it's a donation. Everyone knew they were investing, and Alex put up an interesting sign when he was talking about the different values on the trading. And he said, well, right now there's a 300% return on Tezos. Most of the returns there were astronomical, 300, 500, 1,000%. 99.9% of the people who are buying into these ICOs, they are doing it not for the utility, they're doing it to make money. And they want to and it goes to the secondary trading and all of that. So when you take an ICO like Tezos, what's being different now, and this goes to my ICO 2.0, Telegram right now is the first time with ICO, institutional money is running into Telegram. They are now holding periods, rules, transparency. And I think that's good. I do believe, and I've published on this, some regulation is needed, some regulation is good. I do believe there are a lot of laws on the books that currently apply, but it's a new space, it's a new time. The testimony yesterday was it takes 20 to 24 months for an investigation. I do think you're going to see the SEC come out with a lot of what happened in 2017 in mid to late 2018. So we're first going to start understanding what happened a year ago from the government's perspective.
So by the way, Gary's answer was right. The answer is that there is demand because secondary markets are difficult with regulated securities, right? And we don't have that problem in the world of tokens. Thus the demand.
We do, because they're securities. There's a misnomer that, well, if we call it a token, we can sell it on a secondary market. The reason that the secondary markets are now also being sued successfully is they have been by David, is that inconvenient fact. And so the client yesterday who said to me, I want to sell tokens, my investors want to buy tokens, and one of the reasons is they thought, well, we'll have greater liquidity. We'll be able to sell it on the market. Right. And I said, no, you won't. It's just like selling a share of Series A stock. You're going to hold it for a year, you're going to be subject to Rule 144, et cetera, et cetera. So there's no difference.
The difference is the perception of the client and the perception of the investor, right? Going to the point. That is why they all want it to fit into the box that doesn't exist. So with that being said, going to Jason, do you think, or do you feel like there will be some sort of shift in regulations, especially as it pertains to, I guess, two things? One is the offering of securities tokens that might be a little different than the way that we offer securities presently. And do you think there'll be any changes to secondary market to secondary market regulation in 34 Act?
I think that what you've been seeing, if you're looking, is a slow ratcheting up by the enforcement agencies of what's happening. You had the Dow in July 2017. You know, they managed to regulate without regulating anything. Then you had Tezos coming out in September. There was the RE coin and the DRC worldwide SEC enforcement action by tokens. There was one in Canada recently, I think Plex coin. So you look, the SEC gave its guidance, and if you listen to them, what they're saying is that we think that there hasn't been a utility token offered. And now they're bringing enforcement actions. And that's, I think, what's going to happen now. I don't think that there's going to be a large push to have new regulation, particularly when you have the current administration that wants you to remove 22 or 24 regs for every new one that you put up. So I don't know that there's going to be new regulation. I think that what all of the regulators are going to try to do is they're going to try to fit what we have to it. And the CFTC is trying to work around this. They've recently issued some reports, including a backgrounder in early January about what the limitations are for when the CME comes out and has these derivative products related to Bitcoin. So I think you're going to see a lot of internal rulemaking to the extent the agencies can do it, and then they're going to and regulation by enforcement. That's my take.
So any surprise, Gary, this week with, I mean, I think for a lot of us, there's been kind of an obvious progression, right? Like, we have like a little bit of like bulletins to lawyers, you know, stuff going on. Hey, you can't do fraud stuff going on. Hey, lawyers, really, we're coming after you next, stop it, okay? So we've had this kind of like little thing. Were you a little surprised at the congressional testimony this week? And what to you does that say?
Yeah, no, I wasn't. I mean, it echoed comments that the chairman made in December that kind of alluded to the people who are advising these companies. So I wasn't that surprised. I mean, certainly had a lot of people forwarding it to me, thinking, you know, your practice is about to end and Armageddon's here. And I was like, no, I think that we've, tried to go about things the right way. I guess the one I don't want to say frustrating, but one kind of outstanding point is I feel like the SEC has left open a small possibility of a utility token. Like a lot of times in their comments, particularly to, you know, when it's just one-on-one, they'll say, you know, we do agree that there's a possibility of a utility token, and it would be better if there wasn't that kind of, it would be better if there was a little bit more certainty, because I feel like the chairman and others are getting on lawyers for telling people that it's uncertain, that there's a possibility that the token couldn't be a security, and yet there hasn't been kind of definitive guidance on if there is a utility token, then what exactly does a utility token look like? I mean, my own personal test of a utility token would be something like iPhoto, where you buy 5 credits and you spend 3 credits to download a photo, and then there's no finite number, and it's always going to be the same. That, to me, would be a utility token. So it would just help if we had some clarity around the utility token thing before they kind of jump on the lawyers and say, you know, you've been too wishy-washy with clients.
Fair point. Mark, we're going to wrap up. We've only got 5 minutes. So,
You want to respond?
okay. So,
We're going to take some Q&A so that these guys, the audience, worth their money for the $10,000
yeah,
panel.
What's amazing?
We got all the lawyers in the table over here, so why not? Ask a question. We're going to have first some questions.
What's amazing, Sydney, is I always bill my biggest client for times like this. No. Now the bad news is you're my biggest client. Mark.
Yeah. Yes, sir.
Can you give us like a 1 minute kind of wrap up with some thoughts? And then we'll go and ask
some thoughts are again, I will say again, cryptocurrencies are nothing new in terms of securities. There are all kinds of securities. I think we will get regulatory action, for example, on secondary markets, but it's not just for cryptocurrencies. What we need is regulatory action on all kinds of privately issued securities, and I think we will get that at some point. And the other thing I would say is, you know, there's a saying that says there are two things you never want to see being made. One is sausage, the other is law. I'm very skeptical about listening to congressional testimony or comments from the chairman of the SEC or comments at SEC hearings. Very, very skeptical. That's not how lawyers decide what's legal, okay? None of those things has any bearing at all on what's legal. And instead, lawyers look at the law, we do research, we look at regulations, we look at case law. That's how we decide what's legal. And if people had done that last July, they would have saved themselves a lot of grief and money, and they would have cost David a lot of money. But that's what we need to do going forward. We don't need to swing the pendulum. We don't need to pay attention even to what's being said in the news media, even by the chairman of the SEC, okay? When the SEC issues a regulation, we read the regulation. When people speculate, when people have comments and even write op-eds, it doesn't really matter. And if we could just focus on what matters in the crypto world, we would avoid all this swinging and zigzagging and anxiety. So that's what I'll say.
Gary, we'll kind of work our way down. Gary, do you have any comments?
Oh, well, I guess for older attorneys in the space, I mean, we're all saying the same thing, that the laws apply no matter, that there is kind of nothing new under the sun. I've heard younger lawyers say, oh, the Howey Test is 80 years old, you know, so it doesn't, so, you know, it's about orange grove. So how can it apply to cryptocurrency? But I think the court and the Howey did a really great thing of laying out principles. But I guess my closing thing for those of you who are familiar with the Howey Test and kind of the central role that it plays here is not just to look at Howey. More, the SEC has emphasized that it has to be really substance over form, and these kind of overly finite readings of Howey to try to find some kind of like something on the penumbrum of the securities law is just not going to fly.
Jason?
I think it's going to be hard to have security, I should say utility tokens. I think it is possible. You need to be careful about it. You need to talk to the regulatory bodies, primarily the SEC, in order to make sure that it's okay. Think about what you're doing. Talk to the right kind of people. Talk to good lawyers. Talk to regulatory lawyers, and plan accordingly.
So I'm going to compliment Jason's firm for a second, because they were one of the first big firms who came out and they basically said, if you hire us, we're going to tell you your token's security. I don't think that required a brain surgeon, but in law, apparently, it took large firms a very long time. Other firms have now followed their lead. But I'm going to go, I didn't get to answer the last question, so I'm going to give 1 minute on the most important thing for you guys to know is the exchange myth. There is no such thing as a regulated exchange. They don't exist. Kraken, Poloniex, Coinbase, Gemini, Bitfinex, they actually are self-regulated, exchanges. They have no rules applying. They have nothing. The next year is going to be about exchanges. Now, I happen to have 2 big cases. They're worth hundreds of millions of dollars. Thank God these exchanges now do $1 billion a day, and they're liquid. But think about that. These exchanges, 5 of them are doing $1 billion a day. They're not regulated. 2018 is going to be the year of exchanges and how cryptos can be traded, how they can be done in exchanges, and how U.S. citizens can participate, but that's where we're moving towards. So keep that in mind when you guys do your ICOs, where you're going to put them to make money.
Thanks. So we have time for a few questions,
Yeah,
but it will be very brief. Here, right here.
Thank you very much. Hi, my name is Alex Cannon, and I'm an enthusiast and an attorney myself. My question is to the panel about the fact that my concern is that the utility tokens and the security tokens are being bunched up together into this one single product that's being frowned upon by the legal community. My concern is it's a very dangerous proposition because a lot of these utility tokens have a real utility. These platforms cannot function without these utility tokens, the distributed ledgers, the distributed voting and validation mechanisms over masternodes. You cannot make that work without a utility token. So my question is, do you feel like all utility tokens are securities? Because respectfully, that's the easiest thing for a lawyer to say. Or is it because of the way they're being offered to the public that makes them securities? Because the token itself is an integral part of the machine. It's like selling the tires for a car. The car doesn't work without them. So is it the way they're offered to the public? And if so, are there other options, such as offering these tokens for free, that would allow some of these companies to circumvent an otherwise difficult path?
So let me actually have David answer it first, and then we can kind of go around. But let me focus the question, I think, and maybe say it a little different way and see if you agree, which is the problem here that we're calling them utility tokens, but we're using them to raise money in ICO? Or is the problem in and of itself that it's a security even if you give it away for free because people are using them in the secondary market? David, I know. By the way,
David, we have
you're
few
good.
times.
I know David's answer already, but I think it's instructive just because he's so extreme.
We have a few minutes, so let's be quick.
I'm going to do it in 10 seconds or less.
Yeah, 10 seconds.
It doesn't really matter if you have a utility function in a security token. So to me, it's a red herring. You can sell the token and still use the utility. But it is, if you're selling it and people can trade it and they want to make money, that's a security.
What if instead of raising money with it, you just airdrop it and give it away? Is that a security at that point because people are in fact going to be selling it to each
I'm going
other?
to pass the question to the regulatory lawyers.
There's a 2000 opinion by the SEC about airdropping, in fact. I was reading it today, it just so happens. And what they say is the issues that the SEC has with airdropping is if you want to airdrop something, you're potentially creating a market, you're creating buzz, and if you're doing that, then you're getting a benefit from it, and therefore the airdrop itself is a security. So you can't really do that. And by the way, to everyone's point, that's a 2000 decision, maybe 2003. So we're talking about nothing new under the sun. But it is something there, and I think it's a problem. I don't know that you can wrap a utility token into a security token. I just don't think that they combine.
Yeah, I guess a couple of thoughts on that. The airdrop thing, we have more and more people going the airdrop route. For those of you who don't know, airdrop is basically you're giving away tokens, and the way it has been kind of historically, which is a funny word to use in this space, but anyway, for the last
Week.
Yeah, a couple of weeks, what airdrop was that creating a buzz where you're airdropping tokens to a few people and generating interest, but then you're selling the tokens to the other people. And what people are doing more and more lately, they're airdropping all the tokens. So you're airdropping every single one, which does make this issue of whether it's a security or not a little bit different because you don't have an investment of money, even though everyone up here will say that the investment of money part of the Howey Test has been interpreted very broadly. But a lot of people have this revenue model where they just want people to get on the platform, and once they're on the platform, they'll sell them cosmetics or something like that. They just need people to be on the platform, and so that creates a little bit of a tougher, closer issue. For the gentleman's question on the utility token, and some of these platforms need a utility token, I appreciate that. The thing is, why do they say, well, we're only going to have 1 billion tokens, and we're going to have this 2-month ICO, and then we're going to burn all the tokens afterwards? If you have this platform and you need people to have these tokens to use the platform, then it needs to be just an infinite amount where people can always go in and buy it, and there's no reason for the price of the token to be going up and down like a stock.
And my quick answer is you can absolutely have a utility token that is not a security if you want to.
Okay, that's good. So we have time for one more question. That's all. Thank you. Very briefly.
Sure. I think I can bring this home, I hope. Excellent presentation. The only thing I think that is missing is what is in people's minds when you say, well, every token is an equity token? People start to think, why should that be? Why should that be? What's missing here is the economics of the token itself, which is all dependent on how people write the white paper, how responsible they are. So I'll give you a few examples. If your token is a utility token, if it's used not just for, say, governance, but something tangible like purchasing or pre-purchasing items on your system, and that is the bulk of the activity in the service that you're providing, then one can clearly demonstrate the economics of that is such that if the network has a large amount of popularity, the coin will in fact go up in value. On the equity side, if there is no service whatsoever that the coin is responsible for instance, one could provide the service by using Ether or Bitcoin to reduce the volatility associated with your coin when it starts, because it will be volatile, then you've divorced your coin from your own network. But so then where does the equity lie? Well, in a responsible white paper, the equity lies in you purchasing back your coin. You've created a market, either with a small amount that you have in reserve or other means, but you've created a market for your coin. Therefore, your coin, the value of your coin is directly related to the popularity of your network, and therefore it's an equity token. Burning or putting the coin back into the reserve, burning emulates dividends. Putting the coin back into a reserve that's responsibly allocated, where no more than, say, 5% of the reserve is used, is also equivalent to dividends. And therefore, of course, all coins are equity coins, and it's very clear then why
Was
that's
that,
the case.
is that a question
That's a
or
question?
an answer?
Well,
Thank you.
it's what I believe my answer to the
Okay.
That go. Okay, that's a comment. Thanks. Ken's going to be later on, have a presentation. One more question. Let's have a question. Yeah. Anybody?
Yeah.
I guess it
It's your
wasn't-
time. Okay. I know, but we'll have you. Sir, go ahead.
This is addressed to Mr. Silver.
Okay.
How successful have you been in assembling a class in these class action lawsuits, and specifically with the Tezos cases?
So,
How successful have we been in the lawsuits?
so we've got about 5 of them. And Tezos presents a unique situation. So the rest of the class actions, we're averaging about 1,200 to 5,000 lack of a better word, subscribers to the class actions. Tezos right now is a unique situation. The community believes that the coin is trading, like Alex's sign put up there, that they've got a 300% return. I think his number is about 250. I haven't actually looked at the value of a Tezzy lately. So while I spoke to over 3,000 people who subscribe to Tezos, they didn't want to put their names on the class action or join the class action because they believe their investment value holds. As the money, and you've seen Tezos 2, you've seen the foundation fighting, trust me, when the value goes to 0, every single person will sign up. So it doesn't really matter whether they sign up now. The question is the security? That's the point of the class action. There will be a class rep. But the people, and using Tezos as a bad example, they don't want to join right now because they believe they're sitting on a 300% return. When that actually gets proven that they're sitting on nothing, they will all come back. And they'll all want their crypto back.
Jonathan, I have a question about that, about this article. I'm sorry, just what about, and we're out of time, thanks for your answer, good question. What about this, all this article coming about the SECs making responsible the lawyers that, and doing all this ICOs? I mean, could you just...
Well, lawyers and other professionals are considered gatekeepers by the SEC, and there is a lot of good reason to do that, right? Because at the end of the day, the SEC can't do anything, and they kind of count on us as people with licenses who are supposedly paying attention in order to make sure that we're giving proper guidance. There are a number of lawyers who've written opinions and other things that companies have relied on to raise money, and it's very bothersome, I guess, to the SEC, but quite frankly to most of the lawyers too, just because we think that is both terrible advice and misleading a lot of people who then come into our office. And so I don't think any of us on this panel will be surprised at kind of who it is, but at some point the SEC is going to come down on some lawyers because, number one, it is relatively easy because they should know better, but going, of course, to Gary's point, maybe we shouldn't know all the way better, right? And so we need some more guidance from them too. So, you're going to see the companies being sued, and you're going to see some action being taken against lawyers, and maybe that's why you're getting some
Mark,
conservative advice.
you told me about it. What do you think?
Lawyers getting in trouble?
Yes.
I mean, the only thing I would add, which is not significant, is when the SEC, the SEC has very limited resources, so they decide to do things. They have to pick and choose. So they typically bring enforcement action against the worst players because they don't want to have a hard, drawn-out case. The biggest advantage to the SEC of bringing action against a lawyer is because the lawyers are going to freak out.
Yes.
And they're going to tell audiences like this, and they're going to write blogs, and they're going to write articles. And, the SEC, by doing that, would get so much publicity for so little money that's, I think, primarily why they would take that avenue.
And Sydney, in DC, I looked at the camera and I'll do it again. If you pay $1,000 an hour for a lawyer, get a goddamn in-writing guarantee that if they flip their position without the rule change, that you get your money back. Because you deserve your money. If you're paying $1,000 an hour, the rules haven't changed in the last 2 years. If you're gonna pay good money, because that's everyone's advice, hire a good lawyer. If you pay your hard-earned money, get a guarantee that if they change their opinion, you get your money back. They'll give it to you, by the way.
Or
I don't think
or don't pay
you guys charge
$1,000.
more than the 1,000 an hour. I know.
Sorry, Cooley was charging $1,200 an hour.
I know that for a fact. Listen, we're out of time. Thank
Yep.
you very much. Guys, we're going to take about 10 minutes break, and we'll
Only
come
if you
back
charge
over here.
1,000, right?
You can seat these guys here. They'll be here. Thank you very much. Thanks, John.